Hey everyone, welcome back to the Price Action Labs YouTube channel. In this video, I'm going to be going over a one short, one level, and one read trade recap, which I made about $1,300 using the order flow analysis. So in this video, I'm going to be breaking down a 4-step system that you can use to catch one-shot trades like I did for ES futures today. So this is obviously the S&P 500 or the ES futures, and I'm going to be breaking down how I found my level, how I read price action in that level, and then ultimately how and why I took the strike. So let's get into it. So before we kick things off, what we're going to do is I'm going to tackle a few problems that I see traders face or that they come to me. And I'm going to look to try and, in this video, solve all these problems. So the first thing is you don't lack effort. The main thing is that there isn't a repeatable system that you can rely on. Right, so I often say systems got to be repeatable, reliable, and robust. And so one of the three main things that break this down is having too much information. So when you rely on EMAs and RSIs, MACDs, and all the lagging sort of indicators, as well as chart patterns and even signals as well, too much information never, ever fixes the problem in the markets. Ever. In fact, there's only three things you need: time, price, and volume. And we're going to get into time, price, and volume in a little bit of detail. In this video, I'm going to be talking about how I find my key levels in only 4 steps. So if you feel like you're missing
Hey there, I just wanted to share a testimony about Price Action Labs and S.T.E.P and how he's helping me. I did Forex for about 5 years and learned a bunch about price action and technical analysis and patterns, and I rage quit for about 10 years and now back in futures. Was looking for a coach, somebody to kind of clear my head and lead me in the right direction with a proven strategy. He's been my coach now for about 2 months. The first week was the best week I'd ever had in trading. I was a data analyst for 6 years. So more data, more confirmation, more visualization, more, am I doing the right thing? And S.T.E.P, he outperforms me every day. The simplicity of his plan, what he does, the knowledge he brings, he shows me every day that I overcomplicate it. It's not about confirmation. It's not about predicting. It's not about strategy that I brought from my past. It's just about listening, understanding his plan, and then just as simple as it is, just follow it. S.T.E.P, my hat goes off to you, man. I appreciate it, and I look for better trading ahead. Thanks.
I want to massively improve as a trader. S.T.E.P's your man. So I was very inconsistent. I was trading 15 different strategies, and through one-to-ones and through stuff that S.T.E.P sends me, I was able to learn, if I keep it simple and use order flow to find out who's in control, who's not in control, it changed the game. So I'm having a lot of success now. I'm very consistent. I'm more patient. I'm a more well-rounded trader. I know when to trade, when not to trade. It's helped me massively. So big thumbs up to S.T.E.P. I'd highly recommend him.
I wanted to give endorsement and recommend Price Action Labs order flow methodology, and particularly the mentorship and tutoring that S.T.E.P is offering. He is very keen and sharp with his approach and framework of analysis. He's very passionate about what he's doing, goes the extra effort to understand each trader, where your psychology is, where your limitations are, and what you're trying to achieve with the markets, and he's going to help you work towards your goal. I've worked with him for a couple of weeks now, and already I've seen improvement in my own consistency and focus to approaching the markets each day, and I attribute that to his framework and his teaching methods. He has an infectious energy and enthusiasm that keeps you engaged. The material is very well presented, very concise, and very detailed to understand order flow and order flow analysis. A lot of veteran traders will tell you that the only thing that matters in the markets is price and price action, and his methodology is going to help you follow price and understand price action.
Moves you're getting in too late, or you feel like you're getting in too early, this video is going to be for you, because I'm going to break down how you can fix that problem. And the way you fix that problem is by having a really high conviction of what key level to trade from. And the last thing is you don't know the why. So when you see candles moving and you have emotions around those candles, the real reason is you don't know why the candle are moving up, and subsequently why the candles moving down. And so at the end of this video, I'm going to give you the system that you want to follow to find key levels and read price action in those levels. So let's get into it. So it's one system that's repeatable, mechanical, and scalable. And so I want you to remember this, right? It's the 4-step positioning process. And when you follow the 4-step positioning process, you get what we call a key level. And so there's lots of different terminologies and there's lots of different words for a key level. I just call it a key level because it's, as the name suggests, it's a level that you want to pay attention to. It's a key area in the market. Some people call this support, resistance, supply and demand. Essentially, it's a resistance area. It's where sellers were in control, and that's why the short I took on ES played out so fantastically. And I'm going to break down how I was able to use this mechanical system to find that trade, and how that level was pretty simple to find if you follow the 4-step process. So the 4-step process being S.T.E.P, the 4-step positioning process. So structure, targeted highs and lows, equilibrium, and price imbalance. So we're going to get into it. I'm going to walk you through each of the steps now, and then we're going to go onto the charts and figure out how I did that. I'm going to show you on the charts how I got it. So first is about market structure. And so as you can see here on ES futures or the S&P 500, ES, S&P, essentially the same thing. One's futures, one would be CFD. As you can see here, market gives us a series of lows and highs and lows and highs and lows and highs, right? One quick thing is, market structure is one of those concepts where it doesn't matter how long you've been trading for, whether you're beginner or quote unquote advanced, you never want to skip market structure, or you never want to skip the basics. So if this 4-step positioning process seems basic, that's good, because it's doing the basics repeatedly at scale that gets you to the results that you want. Okay, so the 4-step positioning process starts with market structure. It sounds basic, it is basic, and it's often diluted. It's one of the most important concepts. Understand how to mark up structure. Now, the thing you want to understand is I've only gone back maybe a couple of weeks. This was a low, this was a high. Then, of course, we had low, high, low, high, low, and high. So what this means is right now, this is now going to be step 2. Everything inside of the most recent low and most recent high is internal structure. So understanding where the swing points are, where the highs and lows are, it's underrated, it's diluted, but you are never above the basics. Okay, nobody is above the basics, so just understand the basics. Next is about understanding the most recent high and low. Okay, so it's taking the previous image and it's simply understanding the targeted high and the targeted low. That's what the T stands for. T stands for targeted high and targeted low. Now, why is the targeted high and targeted low important? Well, there's 2 reasons for that. The first reason is it stops you from getting lost and confused in the internal highs and lows. Okay, there are lots of highs and lows on the chart. That doesn't mean you want to mark all of them up. It's quite the opposite. So you want to focus. So this puts targets, or it gives you focus when you're looking for your key levels, which is ultimately what the goal is. Now, the third reason is the third slide, because once you have your high and low, what you'll notice is I've actually drawn the fib from that low to the high. And so this is another fairly basic, but often very diluted and even totally missed concept, which is about the equilibrium, premium versus discount. Are you above the 50%? Are you below the 50%? So what does that mean? It means that when you have a targeted low and targeted high, the 50% area is simply the equidistant price from that low to high. And so in other words, if you're above the 50% area, you're in a premium. That means we are more prone to seeing shorts. And that is exactly what happened on July the 7th, right? So this short here from July the 7th came from a key level on the 16th of June. I'm going to break down how I got that. A key level that came from the 16th of June, it gave us a short because we were in premium. Now, what's important to understand is that this key level here came from the 16th of June. We had shorts here, 1, 2, and then 3. So a strong area of resistance above the 50% area. Again, if this sounds basic, good. You shouldn't be looking to pass the basics or think you're above the basics or not do the basics at scale every single day. There's no day you're above the basics ever, right? I do this every day and I literally do it every day. Like there's no 2 ways around it, right? That's what gave us the short bias. We were above the 50% area. And if there's one thing you take away from this video is you want to pair your key levels with premium and discount. And the way you do it is by identifying the market structure. So S, identifying the targeted high and low or the most recent high and low. So T, drawing the fib from the low to the high to find the equilibrium, and we're above the equilibrium in this case. And now it's about the price imbalance. And so I'm going to go to the charts and explain how I got this price imbalance. But essentially, we had a previous day low on the 16th of June, and that gave us our price imbalance. So how did I actually find that? So if we go to the charts right now, and we go to ES, I'm going to break down how I did this. So this was the...
Before I met Sandeep, I was already trying to learn how to trade, but I didn't have like a proper method or a system, so I was basically gambling. Thanks to his mentorship, I learned a lot, and he gave me a good system to follow, and especially with order flow, these one-on-one sessions really helped me understand how to move.
Today I would like to share my experience about the mentorship program with Sandeep. The way he teaches all the basics and with so much of patience is really very impressive. My confidence levels really boosted after this 2 weeks mentorship program. Whoever joins, they will really improve within a very short period of time. I highly recommend his program, who will definitely be a consistency profitable trader for sure, whoever joins this program. Thank you so much.
trade, or this was the actual short, right? It was very simple, very sort of clean short, right? So there was the short. So from roughly 75.78 down to 75.40. But where did this key level originate from? So I'm just going to highlight this in yellow, right? So traders can understand and see that. This was the key level from today. Now, what you want to understand is, I'm going to really break this down. This is my most favorite area of trading, is finding key levels, all right? So what we had over here, 16th of June. 16th of June, this was the previous day low, or the daily low from the 16th of June. Now, for those who don't understand previous day highs and previous day lows, one of the most powerful, underrated, and probably one of the only way to find valid levels, in my opinion, right, is simply looking at previous day highs and lows. So what you'll notice is that we have a price imbalance over here, right? And that's what the P stands for. So we've gone through S, structure, T, E, now we're on P, right? And that makes up the 4-step positioning process, because this is how you find your key level. This is how I got my key level, okay? What I found is that previous day highs and previous day lows are the best, right? These are the most superior key levels to use. So if we just take a look at what happened here, 16th of June, we had a previous day low mixed in with a price imbalance, right? There's the price imbalance. Okay, that's the P. That's what P stands for. So what we saw over here was we actually saw the FOMC sell-off here, right? FOMC, big event for June FOMC, the short occurred at that same key level. Just bear that in mind. The short from FOMC came from this level, and this was on the 17th of June, so the day afterwards. Now what you want to focus on is this, right? Look at this key level and look at how powerful the level is, right? We saw rejections giving us a high of day. We saw rejections here giving us high of week. So we had high of day and we had high of week. And so for those who ask me, what's the significance of that? High of day and high of week. The significance of high of day and high of week is this, right? When you have the high of day, this represents exhaustion of buyers, right? This is the most exhausted point of buyers. So I'm just going to write here BE, which doesn't stand for break even. That stands for buyers exhausted. Just going to write BEX, right? Buyers exhausted. Same over here. For the entire week, buyers, again, daily high as well as weekly high, buyers exhausted. So what it's showing us is that for June, it was a very strong key level. We had FOMC sell-off, okay? We had FOMC sell-off, we had high of day, and then we had high of week. So huge amounts of sellers being in control in this area. And I'm going to dive in later on into the video of what I mean by sellers in control. Now, if we just take a look at this yellow zone, going into sort of late June or even July at this point, we had similar sort of price action. So if you just take a look here, it's not a coincidence that FOMC, the daily highs and the weekly highs, this same level continues to hold. Okay, this same key level, notice how it's a price imbalance from the 16th of June. It still continues to hold, right? So this is where the conviction comes from. If you know where buyers and sellers are sitting, and I'm going to show you later on in the video how to see that. If you know where buyers and sellers are sitting, it then helps you with your analysis. And so we had the previous week high from here, previous week's high. And then we had a sweep of the previous week's high, and that's where today's short came from. So today's short from the 8th of July, all right, actually came all the way back from the 16th of June. Okay, that's about 3 weeks later. This is my most favorite part about trading. It's identifying the right key level to trade from. Because if your key level is correct and you backed it up with the right system, with order flow, and you're confident in it, it takes out all the guesswork, right? So this is the most important thing, in my opinion, right? This is the most important thing. Okay, so just gonna move on now and go back to the presentation, and we're gonna just break down what else I saw. Okay, so this was the key level. So going into the market, so this is now between 9 and 9:30 Eastern. This was the message I gave on school. So you're staring at the same thing every day. And what I mean by that is when you stare at the same thing every day, that's because levels repeat when they hold. So in other words, if you found a good key level, your job is to understand where that key level came from and simply execute at that level with order flow. So this is how the plan was for today. So I do this between 9 and 9:30 Eastern every single day, right? So there's never a day where you're above the basics. So I do this every single day, right? This system, it takes me maybe 10 minutes to do, 5 minutes to do. This system of S.T.E.P, it is constantly in my mind and it's constantly on my charts every single day because you can never be above the basics ever. So again, this is what my chart looked like going into the pre-market plan. Again, I had my highs, my lows, my highs, my lows, my highs, and now we were in premium over here. So again, there's that level from the 16th of June. We held here 1, 2, 3, 4, and now we're holding a 5th time. Now, I didn't know that we were going to hold a 5th time, and that's where order flow comes in. But what you want to understand is that once you've used order flow in the past, you just want to drag that zone to the right, from left to right. And that's one of the most powerful concepts, right? Using order flow at levels and dragging the zone to the right, okay? So all my key levels were in premium. 75 on ES, 75, 78 to 86 was my main level. So what I'm seeing is I think we're going to see a break lower down to the 75-60 area down. We ultimately melted to 40, right? My next key level. So this was the plan before the market even opened, before 9:30 Eastern. And this is the most powerful thing you can do is using a systemized approach, the 4-step positioning process, to find your levels so you know exactly where to enter from. You're not hesitating, you're not guessing, you're not seeing, you're not drawing lots of lines and using lagging indicators. You've got your level defined before the market even opens. Now that does take a little bit of practice and skill. You got to know what the steps are, you got to know how to do it properly. You need to put screen time in. But ultimately, if you have the right level, everything else falls in place. And so that is what a pre-market plan should look like. I have my 3 levels on the chart. However, key level 2 was the main one that I was looking for because that's where price ultimately opened. I had my key level 1 and 3 found in similar ways to the way that I found 2. I had them on my charts just in case we got there. Okay. But ultimately, I didn't even need key level 1 and I didn't even need key level 3. I just took profits at key level 3. So what does this chart tell you? This chart tells you everything you need to know in terms of time, price, and volume. Okay, time, price, and volume. So let's start with time. You want to execute all your trades between 9:30 and 11. Okay, 9:30 to 11, you only need that 90-minute window. That doesn't mean you need to stare at the charts for 90 minutes. Today, my trade lasted only about 20 minutes, right? And I was done by 3:30 or 10:30 Eastern time. So my screen time was definitely less than 60 minutes. It was probably about 45 minutes. And that's all you need. So if you find yourself at 11 a.m. Eastern or 11:30 a.m. Eastern, and you're looking for a trade 2 hours later, chances are you're not looking for a trade, you're just trying to gamble. Because once you have your level, you're in and out within the same session in under typically 60 minutes. So what does this chart show you? It shows you the Asian session, which is not super important for this trade example. It's not that important. It shows you the levels, so we can either break higher or break lower, because this is an established level where buyers and sellers are sitting from FOMC, previous day highs from the 16th of June, like I described. And also we see the volume profile. And so volume profile is interesting and it's important. Why is it important? So if you look at the way the volume profile is illustrated to us, what we can see is we can see the gray region, the blue region, and then the gray region. The gray regions represent areas of low volume, and the blue region represents areas of high volume. So in other words, what that means is this: 70% of the previous day's volume occurred in this price band. So I haven't got the prices here, but this was the price area, price on the y-axis, 70%, the high volume area. Anything outside of that, so the gray regions essentially, are low volume areas. So this key level was technically in a low volume area. So what did that mean? What it means is markets may chop a little bit, we may get a little bit of chop or indecision before the move happens. The way to get around that is to simply wait 5, 10, or 15 minutes before the execution takes place. And I'm going to break down an example of how I didn't do that. But this was the execution itself. So I executed at 71. My first setup came here. This was a little bit early at 9:38. Second setup was a little bit better. That came at 9:47. So looking back at this trade now, I eventually trailed my risk down to here. So I risked about $900 in the end in total. First entry was a little bit early. This was at 9:38. Second entry came at 9:47. Now the 9:47 entry was better than the 9:38 entry, I'll be honest, right? But I'm going to break down why I took this. And for those who've watched some of my previous videos, you will understand what was going on in this video, right? Because the only way you can trade at a key level properly is to read the order flow. Okay, I'll say that again. The only way you can trade at a key level is by reading the order flow. So you want to move away from guessing and gambling to reading and reacting. And the only way you can do that successfully is with order flow. So there aren't actually that many strategies I've seen, or anyone has seen really, that works without order flow. You have to have an understanding of where buyers and sellers are sitting, so how to find key levels, and you need to know in the now time frame, in the live markets, what's going on between buyers and sellers. You have to do that if you want to trade successfully long term. You have to do that. There's no two ways around that. So what you can see is the areas I've circled are the areas that got me interested in the short, right? So we're going to break this down. Let's do it. So let's break down this short trade, right? So the trade, of course, my first entry came at 38, right? This was 9:38. So what caused me to take this short at 9:38? Well, a couple of things, right? We had an aggressive break below the level. But what was going on at 9:30, 9:31, 9:32 before this heavy aggressive break to the downside? So first of all, what you'll notice is we wicked above the level where I've circled. We wicked above the level. So for those who use wicks, or you try and use wicks, without order flow, that's not really trading at all. That's gambling. But with the wicks itself, what do you see over here? Now, this strategy is all about you finding the right level. This is not going to work if your level is not correct. Okay. Now, if your level is correct, order flow is pretty straightforward, because what you can see here is we've broken below the zone, right? Stop and look at this. Maybe pause the video. You can see a very clear and classic break below the zone, right? Everyone can see that. Now, what was going on inside the zone and just above the zone? Huge blue delta, huge amounts of blue delta, then we break to the downside. So what does blue delta represent? And also, what does red delta represent? Okay, so red delta means that there's more aggressive buyers, or there's more market orders looking to drive price down. The bid, right? The bid is greater than the ask, right? The left number is greater than the right number. But up here, it's the opposite. The right number, the ask, is greater than the left number. And so what this means is that there are more aggressive buyers than aggressive sellers, but market moves down. So there must have been some kind of invisible force here, quote unquote, invisible force that caused markets to break lower. Think about it that way. Market breaks lower, tons of aggressive buyers, there were obviously some kind of invisible force driving this price down. Okay, here's another image of that. You can see my executions here. This one was a bit early. This one was much better. So we're going to break down this execution here. What was going on inside of this level here? So again, the blue box is the key level. What was going on inside the blue box where you can see me drawing my little dodgy rectangle? What was going on inside the key level here? This one. Okay, maybe pause the video and think about it. Live order flow execution. So what you can see here is blue delta, more aggressive buyers and sellers. Same over here, more aggressive buyers and sellers. So it's showing you that the market orders, there are more market orders in the zone that are looking to buy or aggressively buy. But what happened is we continue to break lower, and that's where the execution came from. So as we break lower, the only reason I'm hitting sell, 15 contracts MES, the only reason I'm hitting sell is because I saw all of this and all of this. And notice how we have the zeros at the top, right? So this price action here is where I've circled over here. And that's what gave the short trade, or that's what essentially, that's the reason why markets went short, right? Markets went short because buyers were absorbed, right? Aggressive buy orders where I've circled, right? So where I've circled here, where I've circled here, all these buyers failed. Right? And that's why sellers were in control at the zone, and that's why we had a massive short. Okay? As simple as it sounds, that's the only thing you need to trade levels. You need to have the right level, and you need to have the right read of price inside of that level. There's no other way to do it. So entry at roughly 70, 75, 70. Entry could have been a little bit higher. I mean, this first entry here was a little bit FOMO-y. I got in a little bit early. The entry should have been around here. Huge buyer aggression, right? Buyers were not rewarded. Market from 75, 77 to 80, let's just say around 80. 80 to 77, huge, a ton of aggressive buyers. Market breaks lower. And so the principle to understand is this is how key levels are formed. This is how key levels work. Key levels don't work based on rejections or what you see, or even worse, indicators. Key levels form based off passive buyers and passive sellers. You do not see the passive buyers and passive sellers on the chart. You only see the aggressive sellers and aggressive buyers, as you can see on the footprint charts. When you see a lot of aggressive buyers here and a lot of aggressive buyers here, and market continues to break below the zone or break lower, this is the only indication you need to go short. Okay? So we're going to quickly sum up this video and what we've gone through. So we're going to quickly go through this. So the short itself was, it all came down to using this mechanical system. So it's about understanding your structure, your highs and lows, so targeted highs and lows. We were shorting above the equilibrium, so we're shorting in premium, and we're shorting at a price imbalance, which is how I find my key levels. So we went through, market structures. We were shorting in premium. Very important to understand this step. We were shorting in premium. Sorry. And we had a key level that came supported by the market, right? Market supported this key level, right? So again, your pre-market plan should look something like this. You've got to have key levels, buyers and sellers, where they're in control. And then from here, you want to read the order flow. So I'm going to stop the video at this slide. I'm going to finish this presentation on this slide. And I want you to look at the entry, because you don't need to read any of the numbers or hardly any of the numbers inside of the key levels. You just need to understand who is aggressive and who is having follow through. So in this case, buyers are aggressive in the level. Buyers are aggressive in the level because you can actually visually see the delta inside the candles. Your job is to read the delta, see who's having follow through. So sellers are having follow through because we couldn't break above this level. And then you want to short. And that's how you use order flow to see that sellers are in control. And that's how you get involved in the short.